Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and those 10-year notes. Yields way lower coming into today and even lower after the non-farm payroll number came out on headline, weaker than expected. So we put in a new year-to-date low in yields. We got down below 230. It looked as if things were going to start to snowball a little bit, and then voila, as the day set in, as the risks from the overnight Syrian incident sort of diminished in people's minds, and then you looked a little deeper into the jobs numbers, they weren't as bad as the headline printed. Things started to move back, and once equities caught wind of that and equities started to go higher, it was all downhill from there for everybody else. If you looked at what happened in risk assets, whether riskless assets, whether it be treasuries, whether it be gold, you saw everything reverse back to where it was when all this started. So when you look at what happened pretty much in treasuries, it was the same. We saw those low yields. We rallied about 10 basis points in treasury yields and 10-year yields. We're right now trading about 237. So that kind of takes away from some of the luster. But we did put in a new year-to-date low in yield, so that'll be our new mark, 228. And I think that as we move forward, that'll be a gauge as to whether or not this market is going to continue to move towards higher yields or lower yields. And right now, we're kind of in between on the fence. And if you look at where market volatility is, market volatility has been on the rise here, at least not going lower for quite some time, going back a few weeks, and we've slowly seen yields creep lower. Well, volatility did come off the highs. It did see a spike on the overnight trade, did see a spike on non-farm payroll. We didn't see it really come off that much, which is odd because typically after a non-farm payroll, at least over the last several years, you've seen volatility hit the basement and it's sort of become a boring trade almost. So I think volatility right now holding its 14-day moving average after non-farm payroll, despite the fact that we had all that business overnight, suggests that this move may not be over. The market's not sold yet that all is well. And when we look to next week and we have Janet Yellen speaking on Monday and we have some other news, we have a holiday shortened week, there could be some crazy trades out there. And I think right now, even though risk parameters have sort of been set, if we get below 230 in yields, we're probably going to see a big move lower. Likewise, if we get back above 245, we might see a migration trade back towards 260. I think that right now we're sort of waiting for that next bit of news, and it isn't going to take a rate hike, and it isn't going to take some kind of military conflict to get it. I think it's going to come in little pieces, whether it be from economic data or, Janet Yellen is the great balancer. So while we did see a move and normalization trade today, she may come out and talk about balance sheets. She may come out and talk about Fed rate hike expectations, possibly shifting us one way or the other, or limiting the number of rate hikes or how aggressive the Fed may be. And that also may push yields one way or the other. But right now, we're kind of on the fence. We did see a new low yield. We do have some data in Yellen next week, but again, it is a holiday shortened week, so that'll be something to keep an eye on. This has been Todd Colvin coming to you from the floor of the CME Group.